Good morning, everyone. Now, first and foremost, I'm going to try my best to keep you awake. I know we just have had some food. And good commendations to the conference. It was a great start, that's why. Now, my name is Romari Cameron, and this is a joint work by Dr. Wayne Robinson and myself. It's the Debt Growth Nexus Revisited, the role of trade, financial debt, and exchange rate variability. Before I continue, I must make the disclaimer that the views expressed in this paper are those of the authors and do not necessarily represent the views of Bank of Jamaica or its Monetary Policy Committee. Now, to continue the discussion on the drivers of macroeconomic growth, we look at our motivation. We know that it is important for emerging markets and developing economies to access financing to grow. However, if debt accumulation is excessive, there can be a slowdown in economic growth. As well as we have to consider the initial conditions for emerging markets and developing economies, as well as the structure of the debt. Now, looking at the chart on your left, you would see that since 2010, there has been an increase in debt to GDP for emerging markets and developing economies. Similarly, you would have been seeing a decline or a decrease in average growth. Now, these trends were exacerbated, of course, by the coronavirus pandemic. Now, we looked at a group of emerging markets and developing economies, looking at the chart on your right, and note that these economies typically target or have a benchmark of debt to GDP of around 50 to 60% coming from the IMF Article 4. So this leads to the discussion on the optimal debt level. Now, the topic is still highly debatable, but the debate really took off with the Reinhardt and Rogoff paper 2010, Growth in a Time of Debt. They found that for emerging markets and developing economies, growth rates sharply fall off at debt to GDP levels above 90%, but growth also deteriorates significantly when external debt exceeds 60%, pointing to a potential or possible target of 90 and 60. Of particular importance to us, that is for Jamaica, is that Jamaica also targets or has a benchmark of 60%. Now, if their results have been challenged over the years, one particular challenge came from Erdan et al. 2014, where they challenged the statistical methodology. So it leads us to two main questions. Is there an optimal debt level? And two, is the relationship nonlinear? That is the relationship between growth and debt. Now, a further survey of the literature shows that there's no general consensus as to whether the relationship is linear or nonlinear. However, where authors found nonlinearity, the thresholds vary widely, conditional or dependent on the sample, time frame, as well as the statistical methods used. Now, for our contribution, we argue in this paper that heterogeneities matter, so we should account for structural features. The three that we include in this paper are openness to trade, financial debt, and exchange rate variability. The IMF, World Economic Outlook 2017, posited these features as important for emerging markets and developing economies alongside strength of institutions for their growth. To the best of our knowledge, we are the first paper who that looks at these three features together. Next, we argue that transmission channels are interdependent. That is, we should simultaneously account for the channels through which debt affect growth. Private savings or investment and government total spending are included in our paper. Now, we see in the literature where they typically analyze different channels separately. Now, our two main findings are, for emerging markets and developing economies, the debt growth nexus is nonlinear, and the debt threshold at which the growth trajectory changes varies based on the degree of trade openness and exchange rate variability. Also, that 60% or lower debt to GDP threshold is mostly applicable to emerging markets and developing economies with low trade openness and high exchange rate variability, as well as emerging markets and developing economies with high debt costs. Now, the rest of the presentation is as follows. We look at the data and stylized facts, methodology, results, and conclude. Now, let's orient you to this graph. But before so, the data is a panel of emerging markets and developing economies, of course, 156 countries over the years 1980 through to 2021. So with this chart, it's a Reinhardt-Rogoff type chart where they look at different bins of debt to GDP and the associated long-run economic growth, which is measured as the rolling 10-year average in our paper. So looking at the first column, we see that is debt to GDP up to 30%, then 30 to 60, 60 to 90, 90 and above. Now, what we're clearly seeing is that there's a negative association between debt accumulation and economic growth. Now, the fall off is more pronounced for debt to GDP above 60%. That's in between the two middle columns, right? Next, we went a bit further by testing the statistical significant fall off between the different columns. That's in the real GDP, long run real GDP, and found that the first statistically significant fall off occurs between the 30 and the 30 to 60% bins, leading to the question, is 30% the threshold? This pattern is stable over time where we look at 20-year overlapping intervals. For example, we start in 1990 and look at the 20-year period between 1990 and 2010, but we increment by 5. So then next is 1995 to 2015. Now, additionally, we see that the critical points or statistically significant fall-off is dependent on the degree of exchange rate variability, trade openness, and financial depth. Now, exchange rate variability is the variance in the log difference exchange rate, trade openness, the typical measure of the sum of imports and exports to GDP, and our measure of financial debt is the one that we think is most describes EMDEs better. It's a measure of banking system, well, bank sector assets. It is the deposit money bank assets to GDP. Now, to answer these questions, the first thing that we do is apply cluster analysis by using a k-means partitioning clustering to account for the heterogeneity among EMDs. This is where it's a machine learning type of algorithm where elements are placed in groups based on some feature, and the feature of the group that they're placed in, or the average feature of that group. Now, we prefer this as it allows the data to be classified, right, into homogeneous clusters, and that is unsupervised classification, rather than imposing some deterministic breakpoint, which can lead to some bias. Now, in order to choose the optimal number of clusters, what we do is that we identify the point of inflection on the graph of the within sum of squares. Now, this is also known as the knee of the curve method. We look at the graph, and then there are also additional plots, the log of the within sum of squares, eta squared, which is synonymous to r squared, and the proportional reduction error. And the whole idea of this is that we want that the addition of further groups does not increase the variability in additional groups. So the optimal number would be at the inflection point. After we've done that, then we describe the groups based on a statistic classification, which I'll expound on. Now, we use a panel threshold VAR by adapting the KNR and Hansen 2014 approach to a panel VAR in the following dynamic panel T VAR X, X here for exogenous, where Y is the matrix of endogenous variables with long-run real GDP growth per capita, general government gross debt to GDP, private investment to GDP, and general government total expenditure. X here is the matrix of exogenous variables to include population growth and years of secondary schooling. I, importantly, is the indicator variable that takes a value of 1 if the threshold is greater than a threshold value gamma and 0 otherwise. Now, the optimal debt threshold gamma star is that value that minimizes the determinant of the residual matrix over all possible values, for which we did a grid search in most cases between 0 and 100% debt to GDP. After which we test for nonlinearity in gamma star by using Hansen 2000's bootstrap approach. Now, moving to the results for the cluster analysis, we would have recognized from the within sum of squares plot, the point of inflection shows that the optimal number of clusters is 5. And regarding our static description of the clusters, it follows a particular rule. A criterion for a cluster, that is the exchange rate, variability, etc., is high or low if the mean of that criterion is above or below the 50th percentile of the full sample. The table below shows the results, and what is popping out is that when you look at cluster 1 and cluster 2, they have the same classification of high, low, low for exchange rate variability, trade openness, and financial depth. So we took a further look at the clusters, or at the countries within the clusters, and note that for cluster 1, they have countries who would have underwent or have experience of political and social instability over the period, to include countries such as Congo, Myanmar, Sudan, etc. For cluster 2, well, in that basis, we actually remove cluster 1 from the assessment, as we believe that their results are going to skew the interpretation of the debt growth nexus. With respect to cluster 2, it includes countries such as Colombia and Indonesia. Cluster 3, which has high exchange rate variability, low trade openness, and low financial debt, includes countries such as Albania, Bolivia. Jamaica is in cluster 4 with high exchange rate variability, trade openness, and financial debt, alongside Costa Rica. Cluster 5, low exchange rate variability, high trade openness, high financial debt, includes countries such as Barbados and some OECD countries. Now, to bring us to the baseline results from the panel VAR, in the first column, we're seeing the samples, as well as in the second column, it's the optimal thresholds identified, the significant p-values are in the third, and then the confidence interval in the fourth, coming from the bootstrap methodology. So two important observations that we made is that the 51 for the full sample is insignificant, which suggests no nonlinearity, and this suggests a high degree of heterogeneity, which is posited by Chabich et al. In 2018. Also, we noticed that the homogeneous clusters show results which are significant at the 5% and 10% levels, pointing to the existence of nonlinearity in the debt growth nexus. Now, looking further at the baseline results, we make two additional observations. First is that trade openness seems to be a key distinguishing feature for the debt threshold. Particularly, low trade openness, when you look at clusters 2 and 3, irrespective of other characteristics, typically have lower debt thresholds. High trade openness, looking at clusters 4 and 5, have thresholds significantly higher than that 60% we would have seen at the start. So a 60% threshold is more applicable to countries with high exchange rate variability and low trade openness. Now, it is important to consider the features of the debt. One particular feature is the currency composition, where we look at the external debt proportion to total debt. We also consider the cost of debt when we look at the interest payments on debt as a ratio of tax revenues, and if that ratio for a country is above the median for that cluster, we term it as higher, describe it as high debt service cost. If the external debt is greater than 50% of the total debt, high external debt. Now, the two important or main observations that we make here are that the debt thresholds for countries with a high level of external debt is significantly lower than the baseline. That's the chart on your left. Then next, we observe that the debt thresholds for countries with high debt costs is significantly lower than the baseline thresholds for countries with high trade openness. Next, we move to state-dependent local projections, adapting Zorda 2015's local projections model, where in this framework, Y is the long-run per capita real GDP growth, X is a shock variable, which is the change in the debt to GDP ratio. Z here is a vector of control variables, which includes the first lag of the variables in the panel T var X. Now, two important points to note is that given the potential endogeneity between the dependent and the shock variables, we estimate using instrumental variables and robust standard errors. Now, the results are robust to various specifications where we included an initial GDP per capita to account for initial starting point as well as convergence. We also looked at a delayed threshold effect to account for or allow for the shock to the economy or the economy to be, the state of the economy to be known before the shock occurs. And we also look at the lead or include the lead of the shock variable as suggested by Toylens and Zuban of 2014 to account for the potential bias in local projections. Now, looking at this chart is the results, and I'll describe it for you. When we look at the blue part, it is for the response of countries who are below the particular threshold. The red response is, of course, for countries who are above the threshold when the shock occurs. Now, we're seeing a clear nonlinearity in responses where there's a positive response, statistically significant at up to the 4th year of the horizon for clusters 2, 3, and 4, whereas we see a negative, 2, 3, 4, right. Whereas we see a negative response that is still statistically significant but smaller relative to the positive response. And you may ask why this is so. Our understanding is that governments typically, do fiscal tightening and reduce expenditure so that the negative response is not catastrophic. Now, to conclude, we know that the impact of public debt on economic growth depends critically on the degree of trade openness. Specifically, emerging markets and developing economies with low trade openness have lower debt thresholds, and the 60% benchmark, around the 60% benchmark on the converse holds. Additionally, exchange rate regimes also matter, as countries with more variable exchange rates have lower thresholds, but countries with less variable exchange rate regimes have debt tipping points that are significantly above the 60% identified before. Now, the 60% benchmark seems to be mostly applicable to countries with low trade openness and high exchange rate variability. Also, the debt tipping point for countries with high debt service costs are significantly lower than the baseline for countries with high trade openness. Finally, here is that public debt has a positive impact on long-run growth only when debt levels are below the thresholds. When debt is above the threshold, the impact of the shock is negative but small. Now, finally, we ask, what are the implications for Jamaica? Jamaica's floating exchange rate regime and its openness to trade suggests that, ceteris paribus, it can accommodate debt of 60% of GDP without impairing growth, notwithstanding its low financial debt. Also, we note that for Jamaica, the high stock of foreign currency debt and debt service costs are more binding factors than the current level of debt. As such, it is important for us to de-dollarize the debt, and our liability management should be the priorities for debt management. Finally, Jamaica is highly shock prone, as we all know, so a conservative debt target is still warranted. This brings me to the end of the presentation. Thank you for listening. I welcome your comments and questions.
Dr. Warwell?
Thanks, and congrats, Ramon. Sorry, Romano. Romario. I can't read my own writing. But, so this is a nice paper, as I would expect from a paper that Vin is involved with. Yeah, and I think that, you know, it's more or less ready for submission to a journal, really. You know, one can argue with sort of details, but I think that those are best dealt with by, you know, reviewers for the journal. And let me mention that social and economic studies would welcome, of which I'm an editor, would welcome a paper of this quality. So my comments are really to stimulate some discussion. Let me say also that in amplifying my comment on the quality of the paper, that the setup is nice. The way that you go about it, you look at the data first, and then and the way in which you set up and the distinctions between the clusters and so on, and accounting for the structures of the various of the different countries. That's all, you know, a model way of going about addressing the issue. And the conclusions are plausible. You conclude that economies with that open economies have higher debt thresholds, and that's to be expected because open economies depend on foreign finance to a much greater degree than closed economy or relatively closed. There are no closed economies, but relatively less open economies would do. And you also conclude that economies with volatile exchange rates have lower debt thresholds. And that's also plausible because if your exchange rate is volatile, the country is at higher risk of capital flight if people start to worry about the debt, possible debt levels being too high. So having said that about the paper, let me offer some comments to stimulate general discussion. My basic comment is really that openness is structural, and there's nothing you can do about it. But exchange rate variability is the result of policy error. Because I would always, I've argued, and those of you who are aware of my recent papers will know that with appropriate fiscal policy, you can always avoid excess variability in your exchange rate, whatever your exchange rate target is happens to be. I argue that open economies, and this is now becoming accepted by orthodoxy, that open economies, the exchange rates of open economies have to be managed. The IMF has come around to accepting that, and is generally accepted. But the way you have to manage it, and this is the key that is not generally accepted, is that you have to use fiscal policy to manage it. And the second, there's a key variable that is missing from the analysis because of the setup, because you're looking only at debt growth, is fiscal policy. The second variable that I think is key for growth in the open economy is the one that we talked about in the last paper, international competitiveness. A competitive economy can support much higher debt levels than an economy of similar structure, which is not equally competitive. And most people don't seem to realize that Singapore has one of the highest debt GDP ratios in the world. Those are my comments.
Thanks, Dr. Worrell. Any comments?
Testing. Thank you very much for those comments. I really welcome it. welcome them. And, you know, there are definitely things that I am going to have a discussion with Dr. Rob about to see how best we can, if not in this paper, but in some future paper, incorporate this type of analysis. And in particular, regarding your competitiveness comment, we were considering it at first. We led and eventually decide, but it's something that we typically want to revisit because we know and accept the importance of it. And it's very interesting that you mentioned appropriate fiscal policy can be used as a resolve in terms of managing this exchange rate. It's something I am going to look at personally and, you know, educate myself on in this area. So thank you very much for the comments. Appreciate it.
You might need to read some of Dr. Lehi's work, Dr. Oral work. So I'll open up for questions from the floor. Any questions? Yes?
Like Dr. Worrell, Anton Belgrove, Central Bank of Barbados. I think there's a fascinating paper. Where I would suggest you might be able to strengthen it is to have, because you're effectively partitioning the data into different groups. So you would consider at least another partitioning methodology to kind of strengthen the argument that these clusters are generally robust to, you know, different techniques. And that's, I would say, one of the key things. The other thing I think you could explore a bit more, the dominance of the foreign debt service. I also think that tends to be very much a kind of a limiting factor for countries. So if you could kind of, and I haven't read the full paper, so my apologies if I'm misinterpreting, but I think you could push that a bit more because that to me is at least up an order more important than the domestic debt GDP level. Thank you.
Thank you for those comments. I really appreciate them as well. And just in order of how you mentioned it, yes, well, probably not in order, but thank you nonetheless. For the foreign debt service, it's definitely something we can look further on. I know we covered some aspects of that in terms of exchange rate, in terms of external debt exposure. So that's definitely important. With respect to your other partitioning comments, yes, we can consider others as well. I would have noted why we use cluster analysis and we use various iterations in terms of seeing if the clustering groups are going to, or the number of clusters are going to change depending on if we use like a limit of 20 clusters or less, or the starting point of, you know, which element is selected first, because it selects an element, put it in a cluster, selects another element, put it in a cluster, and then, you know, keeps on doing that. So alongside that, we can definitely look at other partitioning methods. Thank you.
Do we have time for one more question? No? All right, thanks. Let's give the presenters and the discussion a round of applause.